Fine, great. So we are live. Welcome everyone for the Financial Fox for another interesting conversation about investing. And today we are going to talk about gold. My guests are Mark Child, CEO of Condor Gold, and Ian Williams, CEO of Charteris, and also run a gold fund. Welcome to the show.
Okay, thank you.
Yeah, thank you.
Okay, so this is going to be an interesting conversation because gold hasn't been so much in favor since the rise in 2020, came down, but now we are seeing a lot of market volatility with inflation rising, and also there is political uncertainty with the Ukraine crisis. So how do you evaluate the gold performance over the last year, I would say?
Is that me?
Yeah, Ian, go. You go.
Okay. All right. Well, in the big commodity sell-off, when all the commodities collapsed in March 2020, gold didn't really come down very much. It came down, but didn't come down very much. Whereas all the other ones collapsed. Most notably, oil in American oil went to minus $40 a barrel. And even Brent oil went to $20 a barrel. So they all got smashed, and gold never really went down. They didn't go down very much. So the net result was that gold got very expensive relative to all the other commodities by virtue of them all collapsing and gold not collapsing. So when they rebounded, so for example, gold-silver ratio was at its highest in 2,000 years. Gold oil ratio was its highest ever, gold copper ratio. Gold's just ludicrously expensive relative to everything else because it didn't collapse. And then when you had the big bounce back, oil got hit most of all. Oil then gone from, if you just take Brent, gone from $20 to down $90, massive bounce back. Because that was the one that got hit the hardest, so that one was bounced back most. And silver went down to $12, that's now $23, $24. Copper was down at $4,000 a ton, that's now $10,000 a ton. So all that's happened is that gold is relatively extreme overvaluation relative to other commodities has now been unwound by all the commodities going back up again and gold not really going back up. So it's all back in sync again, in a way that it hasn't been in sync for the last 2 or 3 years. And what we think now is that we're entering a period of rotational bull markets. This is a commodity super cycle. It's going to go on for 5 years. All our cycle analysis that we do in-house points to that. But they go in rotation. So at the moment, nickel is the hot metal. Everyone's buying nickel, broken out to a new high. Stocks at the LME sort of 30, 40-year lows. We think the next one to probably go is copper. At the moment, there's probably a bit of copper around, but those stocks are going to dry up in the next 9 months. So copper's then going to break out the upside. And then silver probably. And gold will eventually get round to moving up. And once it starts to show momentum, once it starts to get above $1,900 and then $2,000 an ounce, it'll start to look very good, and all the momentum traders will suddenly start to get more interested in it. Because a lot of investors now trade momentum. So if something's not moving or looks dead or nothing much going on, they have no interest. They just want to be playing in the thing that's moving. And that's why these commodity markets tend to trade in rotation. So at the moment, nickel is hot, oats are hot. There's a few commodities, coffee maybe is on the verge of a big up move. Then when they've had their move, the attention will then switch over to another commodity, which we think the next big one is copper, and so on and so forth. So it's just a question of in the rotational bull market, when is it gold's turn? But it'll come. We just don't know, the sequence of which one is next.
Okay, that's an interesting view. Mark, you're running gold company. How have you been evaluating the current market outlook for gold?
Well, in terms of the outlook, well, I would also just agree with Ian on the commodity supercycle part. It does seem, from my reading, I got all the brokers' research and numbers, but I'm not a fund manager like Ian, so you'll have stronger views on this. But the consensus certainly seems to be that we're in for commodity super cycle, and that'll last some time. And in gold's case, I see it that I ran a company when gold came down 40%, and that's no fun. But it's recovered, and the last 18 months, it's put in a great base. It's traded sideways. As Ian says, it hasn't really done very much apart from consolidate and be a store of value for people. And I think what we're now seeing is a breakout on the charts where you've got the 50-day moving average moving through the 200-day moving average as the golden cross, which is a classic for anybody looking long-term, cyclically, at gold or commodities or even shares. And that suggests that the momentum is on the upside for gold now. And there's every chance that this year you will see, say, 2,200. That's not a particularly massive bullish target. I mean, it's only sort of just over 10-15%. So I do think we'll probably see that later this year. And that's going to be driven by the hedge against inflation, which we've got for gold. It's going to be driven by more consumer demand coming in after COVID, by the jewelry market, central bank buying. But the headwinds that we're going to have are higher interest rates. We could say that the market's already pricing in for Fed hike rates, and gold actually doesn't do too badly in the initial phases of rising interest rates. And it's obviously that's coming about partly because of the inflation and the massive amounts of liquidity that have been pumped into the system over the last few years. So I remain positive on the outlook for gold over the next couple of years.
That's interesting. You brought up the concept about gold as hedge against inflation. That's always been. Is still that correct to say that gold remains an hedge against inflation, or it came maybe off favor because of alternative assets like Bitcoin perhaps have been more popular, even though, I mean, my argument is that I don't think Bitcoin can be called hedge against inflation because it's very volatile. So that doesn't really, it might be a safe haven, but it can't actually be hedge against inflation, where gold is more appropriate to be described that way. But what would you say for this statement or this description as gold against inflation, Ian? What's your take on that?
Gold has a 2,000-year track record that protects investors or whoever by holding gold. Is a 2,000-year track record of protecting against inflation. Bitcoin hasn't got any track record at all. And where people say, oh, well, there's only a finite amount of Bitcoin, you can't create more Bitcoin, that's true. But you can create any number of cryptocurrencies. There's no limit to the number of crypto. You can print cryptocurrencies just like you can print paper money. So if Bitcoin got too expensive relative to, I don't know, some other Bitcoin, Dogecoin or whatever the latest one they bring out. But so we think it's a false argument that, because there's a finite supply of Bitcoin, it acts as a hedge against inflation. To us, cryptocurrency is just a medium of exchange. They're not a store of value. You can't value Bitcoin in a way that you can value gold, because a lot of the demand for gold is for jewelry and stuff like that. Central banks aren't going to hoard Bitcoin in their vaults. People aren't going to girls aren't going to have an engagement ring made of a Bitcoin. Gold has a track record, Bitcoin doesn't. And at the moment, and the problem is that if you extrapolate the sort of trend of inflation over 100 years or 200 years, you get a really good correlation. But there's wild swings in between of overvaluation and undervaluation. But you get there in the end. But you could be going through a period of undervaluation, and then it may stay undervalued for a long time, and then it suddenly goes to a period of overvaluation. But it stays in line with the trend of the retail price index that it hedges you against, but not on a daily or a weekly or a monthly basis, on a sort of, maybe even a decade-wide basis. So it's a rough and ready measure, and people have lost out by buying gold, but they all get sucked in at the top of the cycle, so they can buy. Most people tend to buy it when it's in its overvalue phase, and then it goes trends down to its inline valuation, and they go, well, I've lost money, it hasn't protected me against inflation. But if you buy things at the top of the cycle, it doesn't matter if it's houses or Bitcoin or shares or government bonds, you buy them at the top of the cycle, you lose money. Everything's cyclical. And so you've got to work out really where gold is in its cycle. And we think it was overvalued, it's extreme overvaluation, more overvalued relative to other commodities than it's ever been against silver and oil and stuff. But it's not overvalued anymore. It's back in line. So there's no reason now why it can't join in a bull market in other commodities.
So it's an interesting point that you mentioned about physical gold, that gold is actually something tangible, you can make jewelry, and that is something that Bitcoin doesn't carry. But also one of the other things that maybe is the fact that what you want is an asset that is portable. So there is like this portability of Bitcoin that maybe for some argument can be preferred to assets they are physical. But yeah, I mean, I do disagree as well on the hedge against inflation. And I think gold is not here to be only like an hedge against inflation for the old generation, but I think it comes in the mix also with, in a more balanced portfolio, because you can't just have Bitcoin as a hedge, which is not actually an hedge against inflation. But talking a bit about rising inflation, because last Thursday we saw this CPI number and everybody started to talk about inflation, and perhaps we are going to see inflation stay quite high for the next 3 to 5 years. We don't know how much the Fed is actually going to tighten, because that it also depends on trying to keep the economy afloat. So in an environment with a rising inflation, what is the impact for gold producers, Mark?
Just before I answer that, I just would like to add one comment about the hedge against inflation, to reply to that comment. I think the thing that a lot of people forget is gold is a $12 trillion currency. That's the way I look at it. And there's finite supply. There's finite supply coming out of the Earth's crust of 1% a year. Obviously, you have recycled gold on top of that, which, so that's still there and people can sell. But there is a finite supply, and there's a supply cliff in the industry in terms of production. If you look out 10 years, there'll be a lot less gold coming out of the Earth's crust. In terms of the hedge against inflation, just look at last year, 2021, Turkey. Massive inflation, and gold in Turkish liras, if you put your money in gold at the beginning of the year, you'd be up 71%. Now, you might have been down in US dollars by 2 to 3%. And I think the point to make on gold is that it really depends where you are in the world, the person buying the gold. Why? What is their denominated currency? Is it Turkish lira? Or is it US dollars, or is it sterling? So where are you coming from as your base, as a diversification, and a hedge is a portfolio hedge or an asset allocation as a safe haven thing for many people. It might just be 10% of what they've got. And look at the OECD banks. They've got, central banks have been net buyers for the last 3 years. And about 12% of the foreign exchange reserves globally are in gold. And the rest is spread across US dollars, yen, euros, sterling, typically. So I think part of, if you're a Turkish businessman, you've also made 10 times your money by holding gold over the last 7-8 years, whereas you would have lost the similar amount by keeping it in a domestic currency. So there's a point on that. In terms of inflation, to your other question just now on the producers, there's no doubt that rising commodity prices will impact on the gold producers, and roughly 25% of operating costs within the mining sector are linked in with fuel and power. So if oil goes up to $90 a barrel, then that will come through in the operating cash costs of the mining company. So you can expect their margins, the AISC, all-in sustaining cash costs, on an annual basis to increase as a function of just the fuel and power costs. So people will be looking at alternatives for that, whether they can get LNG or whether they can, and those prices have gone up too, of course, but alternative energy Many people are looking at different alternatives across the mining sector. So that's going to be one hit they take. In terms of expansion from mines and replacement of goods, yes, the prices of any steel or copper, concrete, all that is going up, and that will have an impact on them. But the flip side of that is if gold's doing quite well, it won't be rising perhaps as much as their overall margins. And so I think the profitability will actually be higher going forward with even if gold price stays where it is now.
Okay, that's an interesting point.
Because the industry average all-in sustaining cash costs about $1,000 an ounce, maybe $1,100 an ounce. We're about $800 an ounce. So if gold's at 18, there's still a massive margin coming through to the sector. So you can afford for that to go up $100 an ounce as a sector, and people are still making lots of money, and hopefully that margin expands with the gold price going up.
So it does really depend on the companies as well.
Yes, I'm giving an industry average.
Okay, so yeah, go on, Ian.
So that's the viewpoint from a producer, which we agree 100% with. The point about the current profit margins of gold mining companies, well, all mining, Rio Tinto and BHP Billiton on their copper mines, they're all making loads of money, and they'll continue to make gargantuan amounts of money. But what we've seen in the last year, as this talk, and it's only talk of Fed tightening. If you sort of have an analogy of inflation as a fire, what you've got is Jerome Powell, chairman of the Federal Reserve, with two hose pipes in his hand. One's full of petrol and one's full of water. And at the moment, they're pouring petrol on the fire, and they're talking about fighting inflation, and they're talking tough, but they haven't even turned the water tap on yet. But and they won't turn the petrol tap off. So you've got inflation at 6-7%. You've got inflation. They're talking about interest rates going up to 1%, or maybe 1.5%, with inflation at 6 or 7. That's not tough. That's not being tough on inflation. That's wimping out and hoping, sitting there, that something's going to turn up. But somehow, by magic, inflation is going to come back down to 2%. Well, if they keep pouring petrol on the fire isn't going to go out. It's going to carry on burning. And they're so terrified of the fire going out that they'd rather keep pouring petrol on the fire rather than pour too much water on it. And that's where we are. All this talk about rising interest rates, that's all it is. It's talk. They haven't actually done it yet. And so we think this, the central bank, they didn't forecast the inflation. It completely caught them out. It's not in their models because they're all Keynesian models. None of them take account of any money supply increases. They ignore the money supply. I mean, the Bank of England had an hour, mini sort of document on inflation about why it's gone up. They never mentioned the money supply once. Never mentioned it at all, which is a root cause of the inflation you're seeing all around the world. So it doesn't enter their thinking, and they don't want to put rates up. There's no way they want to put rates up to be in line with the rate of inflation, like Volcker did when he fought inflation many years ago. So they want to put interest rates by the bare minimum they can get away with. They talked up the bond yield, so the Treasury bond yield's gone from 1% up to 2% on the 10-year. And what that's done in the investment scene is absolutely hammered these low profit tech stocks on massive price earnings ratios. So things like Twitter and the Cathy Wood's ARK Fund, and Robinhood is probably the biggest example. Yeah. Robinhood's lost 80% of its value in a year. Cathy Wood's ARK Fund, which is a sort of poster child of the tech sector, lost 50% of it. It's down 30% year to date. So they're absolutely getting killed, because the higher interest rates go up, the higher the rate you have to discount these non-existent profits. And you've seen massive switching out of these tech stocks as a result of the higher bond yields into mining stocks have been the big beneficiary, oil stocks, things that produce cash flow today, lots of it, highly profitable companies paying big dividends on very, very low historic PE ratios. So there's been a massive investor switch. And this is only just beginning. Because if rates, I mean, even if the Fed does put rates up, or if they don't, it's not going to stop the 10 and 30-year bond yields going up. So you could have a 10-year treasury on 2.5% or 3% yield. So that's going to further accentuate this or accelerate this trade away from overvalued tech shares, which are still overvalued, into the mining sector and the oil companies, which are still massively undervalued. Some of these gold mining shares, as Mark will point, are on P's of 2 and 3.
Yeah.
It's ridiculous. And you've got these tech shares on P's of 80 and 90. And the earnings of the gold companies, the profit margin, they're making money today. They're making proper profits. The big base metal miners are paying out enormous dividends at a time when. So
BHP, for example.
BHP and Rio, the yields are higher than the PE ratio. It's just, if you want something to invest in, it's a no-brainer to invest in. So I think the big switch out of these overvalued tech stocks into the mining sector or resource sector, oil and metal miners, including gold and silver, has only just started. And it's going to be a massive move, and there's a huge amount of money to be made being along with resource stocks with very little risk, because you're buying them at such cheap fundamental value.
And also lots of opportunity as well, because that's the play where there are lots of M&As activities as well.
Oh yeah, well that's a function of a bull market. The more the gold and silver price go up, the more the gold mining shares go up, and then all the bankers are all over these mining companies like a rash, putting deals up to them. Why don't you take over this one? We'll back it. At the bottom of the cycle, when the shares are ultra cheap, the banks are nowhere to be seen except when they're M&A. But the minute sector starts hotting, it's feast and famine cycle. The minute the sector hots up, all the banks and the investment banks are all over the mining stock, trying to get them to do corporate activity because they want the fees.
That's true, but there is also the point about, if you are a big mining company or a mining company with cash, you also need to think about increasing your resource base. So what you do, maybe a good opportunity is actually to buy some small gold company. They actually have made some work, or they've got some deposit that could add value to their portfolio.
That's true. That's very true, and that will happen. The biggest obstacle to that happening now is when they all did this in 2011 at the last peak. They all ended up all overpaying for other mining companies, way overpaying, and writing off huge amounts of shareholder value. And in 2013, I think all the big CEOs of all the big mining companies all got the sack because they didn't buy at the bottom of the cycle, but they all bought these overpriced, but they waited till the assets got overpriced rather than underpriced, overpaid for them. And then when the cycle peaks, as it did in sort of 2011, 2012, they ended up having wasted gargantuous amounts of shareholders' money. I mean, BHP, for example, spent $50 billion on a shale oil business that a few years later it virtually gave away to BP for $10 billion. So that's just one company, one trade that wiped out $40 billion of shareholder value. And it just, because it's such a strong company, they just shrug it off as if nothing's happened. But that is now in the mindset of, we've got to be very careful. I mean, even on the chairman's statement when it came out yesterday, we're only going to buy other assets, other companies, if it represents shareholder value. So they're all being ultra cautious. But the problem is the market starts to run away from them, and the commodity prices start going up. And then they start not worrying so much about this and panicking that they're going to miss out. And then it all feeds on itself. So you see what's going to happen. There's reluctance at the moment because what happened 2011, 2012. So they don't want to pile in at the moment when the assets are cheap. But once it all gets going, and once all the investors pile on board, and the hedge funds are all piling in, and that copper's gone from $10,000 a ton to $20,000 a ton, all of a sudden, we've got to buy now. We've got to, because we're going to miss out. Or if we don't buy this, Rio Tinto will buy it instead. And then they're all have collecting so much cash flow that they have so much money to spend. And it just feeds on it. So it's a classic feast and famine cycle. And it happens every single commodity boom. and the big over extreme valuations will probably 3 or 4 years away. But that's when the bulk of the merger activity is going to take place again. Because you know, I mean, we talk to a lot of CEOs of mining companies, and very, very few have a count that sort of want to buy assets at the bottom. They all get sucked in with the gain. And a lot of it's because the investment community won't back. When the assets are cheap and out of favour, the investment community won't back the deals. When they're starting to get expensive, but they're all in favour, oh, you can get as much back as you want. You can raise equity, you can raise bonds or anything. So that's what we think is going to happen with merger activity. So
what you've seen in the gold space over the last 2 to 3 years is nil premium mergers come within the biggest companies, and we've seen that with Randgold and Barrick and Newmont and Goldcorp to consolidate the sector. And so you have seen that in the gold space. And just the most recent one that's just closed a month or so ago was the Agnico Eagle Kirkland Lake. There's 11 billion acquisition that Agnico Eagle made of Kirkland Lake, but it was a nil premium merger. And I think, yes, they get some economy scales out of that, but it also tells you something that gold, as the producers of gold, have been struggling a little bit, I think, with lack of economies of scale and lack of size for some of the big funds to invest in. So even if you take the biggest gold company in the world with 7 million ounces of gold production a year, Newmont, the market cap today is $750 billion US. Now, in terms of the $1 trillion that you've seen for the Teslas recently, until they sold off, but the FANGs, if you like, that's still very small, representing a play, and that's even after that merger I just mentioned. So, if you go further down, the classic thing will happen is that the medium-sized people will want to merge. So the guys who are 500,000 ounce gold producers will want to become 1 million ounce gold producers, and so forth. And the other thing to bear in mind within our industry is that you're either going to expand by consolidating, having bigger companies, and so merger activity, or you go out and buy something else and build it yourself. And it hasn't yet, we haven't really seen the trickle down in the cycle yet to the acquisitions of the developers, because ultimately mines are depleting assets. They have a finite life. Once you've taken it out, that's it. And you've got to go and find another one. Or you either find that yourself or you buy somebody else's. So, and we haven't yet seen that going down to this. There's a little bit happened at the smaller level, but people have been very cautious about going into buying the bigger resource companies that are construction ready, if you like, but are pre the capex of the build. So, but that I'm sure that'll happen in this cycle over the next year, 18 months, with higher share prices. And the balance sheets, I would just say, for the gold producers finally now are the best they've been in the last decade. So a lot of people with very little debt, that'll give people more confidence to go out and acquire things, I think, in due course.
Mark, also you run a small, okay, it's a small cap gold company, exactly, going through production. So I would like you to expand on your approach, because you are thinking, right, I'm going to go into production. How am I going to bring my company to the next level to make it attractive for majors? So just share with us your approach.
Yeah, well, we have a twin approach. I mean, the first approach is to completely de-risk the project. And by that, I mean, you've got to get the permits, which we've got. You've then got to go to buy all the land, which we've done. You have to then and then do a bankable feasibility study, so that it's completely de-risked. So that's what we've been doing for the last couple of years. And in addition to that, we've got 2.4 million ounces of gold and a fully permitted project, and we own 100% of it. So that's been the main focus. I know we talk about investment now, but 99% of my time is actually spent on operations. And we've also acquired a mill, which we've taken into the country. So the way I look at it is that there's probably 4 or 5 companies globally that are at our stage, which are basically construction ready with a bankable study out in 6 weeks' time. And that's taken a lot of effort and time and so forth. It's important when I'm running the company that we run it as we're taking it through to production. So that's exactly what we're doing. And we've built the team locally. We've hired engineers, architects, hydrologists. We have 61 people on the payroll to take us through to the next phase. And so that's important. We're not sitting there waiting for an acquisition, but we're in a market, and it's quite well known in the junior exploration stroke development stage that people, 1 in 100 goes on the frontier, takes the risk and finds something really interesting, and then the majors come along and probably buy it. That goes for most of the commodities, oil and gas in particular, and the same for the gold sector. So are we in discussions with people today about that? No, we're not. Is that likely to happen in the next 12, 24 months? Absolutely. I think there's a very good chance, because we put our study out last year saying 150,000 ounces of gold per annum for 9 years. There's a 12-month payback at 1,700 gold, not a big amount of capex. So, it looks, the numbers look very, very compelling, but it's going to be a question of timing, as Ian says. It all comes down to timing and where we are in the cycle as to when something may or may not happen. And it may happen that someone does something when you're halfway through construction and you're 6 months away from producing your first gold pour. We don't know. We've had some inquiries come in, actually, interestingly, from the mainland China, just saying, okay, are you interested in engaging us? These are from Beijing and actually a mainland China group in Canada. And so that you can see people are sort of looking around. We're not doing anything, but it's just that's what I'm seeing.
So shall we talk a bit more about China? What is, for instance, what is bringing them to look at potential opportunity in other countries? Yeah, go
on. Well, since I've run this gold farm, I've got to meet a lot of Canadian CEOs over the last 15 years or so. And a lot of gold mines have quite big copper output as well. They don't just produce gold. And all the ones that have had big copper output, every single one has had a knock on the door from the Chinese trying to take them over. Because they want to dominate the electric car market. They've worked out way ahead of anyone in the West that in order to dominate the car market, you've got to tie up all your security of supply of things like copper and nickel. So they've spent the last 10, 15 years quietly going around trying to buy up copper, mainly copper assets, but other metal assets as well. So that's what and they're smart. I mean, you can see what they're doing, makes a lot of sense. So yeah, any mine, particularly, but a lot of gold mines have quite high copper anyway. But just one other point, because I agree with all the points that Mark made. I mean, he's exactly on the same page as us. He's 100% in agreement. Just to reiterate the scale of the adjustment that's going to take place between tech shares and resource stocks. At the moment, Apple, which is really a one product company, is valued at more than the entire UK stock market, not just the FTSE 100. Every single stock quoted on the London Stock Exchange, you add up the market cap, is worth less than Apple. So in that index, you have two of the biggest oil companies in the world, two of the biggest drug companies in the world, one of the biggest banks in the world. You have the two biggest, it was still BHP, but it dropped out, the two biggest mining companies in the world, the world's biggest silver miner, two of the world's biggest pharmaceuticals, two of the world's biggest tobacco companies. And we're supposed to believe that Apple is worth more than all these companies put together. It is completely cloud cuckoo there. So that's how overvalued the tech sector is. Yeah. Tesla is worth more than all the other motor car manufacturers put together. It's crazy, it's mad. And if the switch takes place, the sheer adjustment in terms of the movement in relative value is going to be enormous. And the cheapest sector around, if you want to switch out of overvalued tech, the cheapest sector is the resource sector, regardless of whether you're looking at a commodity super cycle. Even if commodities don't move from where they are, we don't think they are. We think they're headed much, much higher than this, because you can't decarbonize without a massive amount of copper and nickel. And the copper and nickel just isn't there. So these prices are going to go much, multiples of where they are today. Copper could go from $10,000 an ounce, could go to 50 or 60 or 70,000. So that's where the money's going to be made. These stocks are cheap. Their balance sheet, as Mark pointed out, balance sheets are in good order, better than they've been for years. The PEs are low, the profits are there, everything that the tech sector hasn't got. And people say, oh, well, Apple makes a load of money. But it's a one product company. An Apple iPhone costs $1,000, of which it only costs $600 to make. So they're making $400 profit per iPhone. Well, you can buy an equivalent Chinese phone that has a longer battery life than an Apple iPhone for $200. So for half of what Apple's profit margin is on an iPhone, you can buy an equivalent phone, the whole of it. So we think we wouldn't touch Apple with a barge pole, because we think as the world gets competitive and these iPhones get commoditized, that their profit margin of 40% on an iPhone is unsustainable. It can't maintain that level of margin.
Ian, when you are looking at stocks and mining stock to invest, do you maybe want to tell a bit more about your criteria for the blue chips, for the bigger one, but also for the small cap that you're supporting?
Our fund has slightly different to maybe one or two of the big funds that we compete against. Our fund has got a 60% silver exposure, 40% gold. And that's not quite as clear cut as it used to be, because a lot of the silver mines have been diversifying into gold, because gold mining is a bit more profitable than silver mining. So what started off as a pure silver mine, there aren't that many pure silver miners around now. But nevertheless, our fund probably has higher exposure to silver because it's got a higher volatility. And if we are in a precious metals bull market, silver will go up more than gold. Plus, also, we tend to, especially post Woodford, but we did it anyway, tend to be in the liquid stocks, because when the Woodford fund blew up, the FCA went all around the fund administrators on the warpath about any illiquid holdings in the fund. So it made life very difficult for funds that invest in micro-cap stocks and corporate bonds, anything that where there's no underlying liquidity. The FCA has been giving all the fund administrators a hard time. So the easiest thing for a lot of these funds was to do was to sell, or if they could, get out of anything illiquid and try and get into as much liquid stocks as they could to keep the regulator off their back. So we were there already. We didn't have any problems with it, but we could have had if we were in there. And I suspect there is a micro cap gold fund that we compete against. I suspect he had a bit of a problem from the regulators about having his fund filled up with liquid stocks. It's all right if you're an investment trust or a closed-end fund, but if you're running a daily dealing fund and you're subject to redemptions and you've got the bulk of the fund in stocks that aren't very liquid, pre-Woodford, regulators wasn't even aware of the problem. But once Woodford blew up, closing the horse out of the stable door after the horse was bolted, they're all over it, but in a way they weren't before. So it's pushed amongst fund managers, it's made them a bit wary about filling the fund up with too much illiquid stocks, I'm afraid. So it's worked against the smaller companies.
But in a way, you still need, I mean, it's not that you need, but in order to get exposure to those gems, that you need to take some risk.
Oh yeah, but you need it. It's probably better to do it with a closed-end fund, an investment trust, or an insurance company or a pension fund could do it. But it's only really relates to all the OICs, all the unit trusts or that are quoted that have daily dealing and daily redemptions. That's where if Woodford had converted his fund into an investment trust and kept all those illiquid holdings, he wouldn't have a problem. They'd still be traded today. And but the fact is, he filled up the fund with, at the time, the legally allowed amount, a percentage of illiquid and unquoted investments. But what happened was he went through a couple of bad years of performance. The big investors drew them started trading big chunks of money out of the fund, he could only sell the liquid assets. So he could only sell his British American tobacco. And then the percentage of unquoted in liquid suddenly went through 10%. Oh, the fund's in breach. So all of a sudden, all hell breaks loose. But when they did it, when they bought these small cap, micro cap, and liquid holdings, they weren't breaking the rules. The administrator wasn't breaking the rules, and the fund manager wasn't breaking the rules. And no one foresaw that the fund would shrink by such an amount that the percentages of the illiquids went above the breach level. So now the ACDs and the regulator, if you're running a fund that has daily dealing and daily redemption, we don't want to see, we want to see the bare minimum of micro caps and stocks that aren't very liquid. And you have to do liquidity tests. They do liquidity tests on every single holding in the fund. So I'm afraid but that doesn't mean there isn't a lot of money to be made in the smaller companies. It probably means there's more money to be made, but you need the right investment vehicle to be able to buy them without crossing paths with the regulator. So an investment.
I think your answer, Ian, is that you're only invested in the big market cap gold producers.
Well, we're in the medium-sized ones as well, but okay. We've had. I mean, in fact, we don't own Barrick. We don't own Newmont's the only big one we hold. Most of our stock is mid-cap rather than, but they're relatively liquid.
Yeah, north of 500 or $1 billion market cap.
Yeah, but you start if we were to start filling up the fund with 20 million, 30 million market cap companies, we'd be getting a call from the regulator saying, "Oh, how liquid is this stock? How liquid is that one?" So it's
this is a perennial problem I have with Condor and taking it through. Yeah. The next steps is you could go around the City of London, you could meet all the gold funds, if they'll take a meeting, of course, because they'll just might look at the market cap and say, look, you're too small. It's below my minimum market cap size due to my trustees' requirements, articles, or whatever. And yet some people will very, very much see, it's not necessarily because they don't like the company or they don't see massive undervaluation. It's just because of the, as Ian's saying, the regulatory requirements. And in some ways, that is very detrimental to London as a financial centre to help, if you like, to fund the junior end of the natural resource market.
Well, absolutely. I mean, if our fund, if we say did a sister fund that was a closed-end fund, investment trust, we wouldn't be hamstrung by any of this. Because an investment, because there's no daily redemption. If you own an investment trust, you sell your shares in the market, but nothing comes out of the fund. So you're not subject to having a false redemption where you've got to sell the underlying assets. So the way to square the circle really is the revival of the investment trust sector with specialists in things like mining stocks. And that way, the small company sector would have access to lots of capital, and the regulator wouldn't be interested because it's a closed-end fund. They're only interested in funds like ours, which have daily redemptions. You see.
Yeah. There's a move over to listing on the Toronto stock market. So 50% of mining finance in the last 5 years has actually been raised on the TSX, not London. And that's all mainly the small to
more junior market. No, that's absolutely right. I mean, but all the regulator does is deal with yesterday's problem. They don't look forward, they don't plan, they don't really have an entrepreneurial hat on. If you rely on the regulators, you're going to be disappointed. What you need is there should be someone, especially the Conservative government, there should be someone in the Treasury, Rees-Mogg or someone who knows a bit about fund management. He's a fund manager. Someone who understands some of this stuff. Have actually got to direct the regulator to make London more entrepreneurial, more open for business, encourage the small, because the small cap stock of tomorrow is the big cap, sorry, the small cap stock of today is potentially the large cap stock.
Exactly.
I mean, BP and Shell started off as micro companies, as did Glaxo, so I agree, it's very important for London, especially now we're out of the EU. In theory, free of a lot of the EU rules, which are even more restrictive. it should be encouraged, but you're only going to get it if government ministers who know something about it step in and instruct the regulator, because the regulator won't do it off their own back.
Right.
Yeah, that's an interesting point. So it's kind of a struggle in the London market. Then can you look outside? Do you have to look outside? I mean, Mark, you are also listed on the Toronto Stock Exchange. Is there an exercise that you're doing perhaps in other jurisdiction?
No, because the regulatory, we're listed on Toronto as well, but 90% of our share volume trades in London.
Gotcha.
Doesn't mean, but we're regulated by both the London Stock Exchange and the TSX and the Ontario Securities Commission. So we have a double cost of regulation, if you like, and compliance. We also have to do quarterly reporting as a result of being on Toronto and file everything on CDAR to 43101 regulatory standards if we put out a new mineral resource estimate or an FS, or feasibility, bankable feasibility, which we'll do in the next 6 weeks or so. That all costs money. It doesn't, but what actually happens is you put a flag post up in that Canada, if you like. So we put all our news releases out, and that the Canadian investment community, because we're the shares equally trade on both, and the share registrar for both is Computershare. But quite often the Canadians might be the people buying in London. So because that's where the liquidity is. So someone will make a price on them in Canada, but the stock will actually be bought through Winterfloods or somewhere else like that in London. For a Canadian account. So sometimes people say to me, oh, well, why? There's no volume on your Canadian listing. Yeah, because we haven't placed shares out there. But it doesn't mean that the Canadian listing hasn't actually attracted Canadian-based investors who are actually dealing in London. Because, you know, you can have a TD Waterhouse account online and you can trade in 10 stock markets around the world, you know, London or Tokyo or New York, as well as Toronto. So I think it does... it's been very beneficial to have it. Would we look at somewhere else? Absolutely not. We wouldn't go to Australia or somewhere like that. It's just a regulatory burden and for us and cost.
But in a way, if there is less cash money from a big institution coming to the small cap space, the flip side is that the M&A activity can become even more interesting, because that's kind of the way the small good company can actually grow. That's kind of the only way. So not the only, but probably the most likely. Well, really interesting. Now, the last point that I would like just to touch before we wrap up is ESG. So everybody's talking about that. And obviously the mining industry has to do something about implementing sustainability practices. So Mark, what are you doing from your side to comply? It's not to comply, but actually to integrate an ESG perspective in your company?
Well, I make the first point that many of the mining companies operate, whether they're copper or gold, operate, and if they're London listed ones or on the main exchange, I'm not talking about domestic artisanal miners or something like that, but the main people have understood 30, 40, 50 years ago that they have to have a social license to operate in the communities that are operating in. And that's been the case in many parts of, so remote parts of Africa where there's a gold mine, or in Latin America, the mine actually is the only source, often the only source of employment. And it's the mine that's actually building the hospitals and building the schools and for its workforce and for the local communities as part of a social license to operate. And the World Bank, through the IFC, the investment arm of the World Bank, I mean, 30 plus years ago, was very much funding the copper mines, or lending the bank debt to the copper mines in Chile. But when they do that, they put in place, the debt providers put in place a whole load of criteria which the mining companies have to adhere to. So they have things called the IFC performance standards, and that can be everything on stakeholder engagement to land acquisition to environmental to social. So we've been through that with the IFC, and our company is fully compliant with the IFC performance standards. But we were doing this 7 years ago. It's not a new thing. This ESG bandwagon, to me, just seems to be the latest, well, not investment fad, because I think it's really important, but I'm just, because of the nature of us operating in difficult jurisdictions, in quite often poor communities, you need to take the communities with you. And we've just got the mine permitted. Well, we've been working on that. And ultimately, now with everyone's got a mobile phone and so on, in any part of the world, it's not just about getting a permit from a government. You need to actually, the whole mines are permitted from the bottom up. They're permitted from communities. So we've done huge amounts of environmental and social work in the local communities, who ultimately, in our case, get to vote on whether they want the mine in their community. I mean, you can now go through all your technical studies, spend $40–50 million, have your processing plant design and your geotech and your hydrology and all those 16 studies that make up a bankable study. But if you can't get the community to vote on wanting the mine, wanting higher standards of living, and in our case, the mines pay 4 or 5 times the local wages, and you get on the national healthcare insurance and you get bank accounts and stuff like that. So but it takes a long time and a massive effort to get communities on board. We have 14 people in a social team just doing all that, and we put drinking waters in the community. We put a $250,000 drinking water project up last year. We're training now 150 people to be the future workforce for the mine, and that's a $180,000 budget that I've got this year. So it's terribly important. We do that anyway. I think it's just a really good way to run a company. But if you get it wrong, it's very easy for people to turn against a company and put roadblocks in, as we've seen in various mines around the world. So it's very important to get the community on board and the local mayors and everyone else. And they're actually ultimately the voters. So the politicians will, if the people say, we want jobs, we want the mine, that feeds through to central government.
I think that's a great approach to take. I mean, Ian, I would like just you to comment on ESG as well, because we have seen big company like Rio Tinto coming out with this bold statement about ESG. As a fund manager, how do you assess the ESG commitment marketed and promoted by the big company, and how to make sure it's not greenwashing and stuff like that?
Well, couple of things. Mark makes a really brilliant point, and the way they do it, a lot of the mining companies are doing this, and a lot of them are doing it anyway. So the mining industry has cleaned up its act from where it was maybe a couple of decades ago, and it gets much unfairly maligned by ESG. You mention mining to some people, oh, it's horrendous, where in fact it's not. And the other thing is that if you're going to decarbonize the world, the world will need more copper in the next 10 years than has been mined in the last 2,000 years. You probably talk about 1 billion ounces, 1 billion tons of copper. Now, the chances are that without the mining industry, there's no decarbonisation. If you don't get the metals, there's no wholesale switch to electric cars and charging stations and wind farms, because they all use gargantuan amounts of copper. So unless the mining industry steps up the plate, and probably won't be able to deliver 1 billion tons anyway, but it'll have a go. The copper's in a massive upward spiral in terms of demand. You need the mining industry. If you don't have the mining industry, there's no decarbonisation. And the mining industry that's going to make all these metals is probably less than, the bulk of it is less than 10 companies, 3 or 4 of which are located in Australia. And so, we look at the issue. And the problem is, you've seen it in the oil company, oil is a sort of big enemy. But so what's happened is a lot of banks won't lend to oil companies anymore. The oil companies have been starved. The pension funds have been told not to finance oil companies and oil investment. So what's happened is that the non-OPEC oil industry, which is 60% of total oil supply, has been starved of investment now for the last 3, 4, 5 years. As a result, non-OPEC supply of oil is falling off a cliff, because it's not getting the investment into making. If you don't maintain the fields, you don't maintain the flow rates. So non-OPEC oil supply could drop 3, 4, 5 million barrels a day this year, another 3. That's why the oil price is at $90 a barrel. So clamping down on the oil industry has just merely resulted in a massive increase in the price of oil. It's nothing to do with OPEC. People looking about what OPEC's doing. Well, the story is non-OPEC and the starvation of investment. So if that happens to the mining industry, all that's going to happen is the price of the raw materials is just going to go up even more.
Yeah.
So you can't have this. You need oil and gas for the energy transition. If in 10 or 15 years time you have electric cars, and if you're going to have electric cars, you need all this metal. You need nickel to make the batteries. So the environmentalists can't have it both ways. If they want to clamp down on resource industries, then there's no decarbonisation of it.
Yeah, exactly. Ian, thank you so much. Mark, thank you for coming on this panel. We are ready to leave, and thank you also all the viewers